Talking about these mid-cap ITs, you think they've run their course, or in some pockets you still see any value?
No, I think they've run their course. So then, most of the positives are already in the price, and I think they'll need to take a break or pull back a little. I'm not saying that the medium to long-term story is bearish, or one should just sell them off their portfolios and get out. But from a trading standpoint, I think one can see a 10 to 20% pullback and then again a ride up, because the sector is looking up, and a very good indicator yesterday were the results that came out from Intel, which has had the best quarter over the last 2 years last night. So it's a very clear indicator that the tech sector is looking up. Of course, Intel is totally focused on technology and hardware more than what we have here in terms of Infosys and the business models of various other companies in India. But it's a clear indication that things are starting to look up globally, and the IT companies have seen the worst. So I don't see that they would see any more pressure on their margins. Of course, the dollar rupee remains a wild card, which is very difficult to game at this point of time, because the global dynamics in terms of the carry trade, in terms of fiscal deficit here, etc., those have to pan out, and those are very difficult to game. But otherwise, I think the business outlook looks pretty positive.
The other mid-cap or non-index space that's beginning to see interest now, Sanjay, is infrastructure / construction stocks. Do you see value there, or do you think that as well may have run its course?
No, I think there is a phenomenal amount of potential, and every dip should be used to buy. You get a 5 to 10% dip, identify your stocks where you've done your research, where you have access to all the necessary information that you need, and I think remain invested there for 3 to 5 years, because there still you can find 3x to 8x stories. And in fact, another sector that I need to point out, which I actually have coined it as infra ancillary. These are companies which are supplying equipment and backup supplies to the main infrastructure companies, whether it is the likes of into pumps, motors, or those kind of things. So I see both these companies absorbing a lot of such kind of equipment. The infrastructure companies will be buying from them, whether it's cranes, whether it's heavy equipment, etc. And similarly, I also see a good amount of capital expenditure coming in from the corporate sector. The kind of money that power sector is going to spend, the kind of money that is being raised by various other companies, is ultimately going to be given out to the equipment sectors. So that's one area where I'm very positive on, and I think there's tremendous potential in companies in those areas. And most of these companies are in the mid-cap and small-cap range, and there are very few companies which are large-cap. And even if there are some large-cap companies, they're fully discounted, the upside from here, whether it's BHL or L&T, etc.
If your call is, though, Sanjay, that the market's probably headed towards a bit of a blowout and there's more to go for the frontliners, tactically, which heavyweights would you be overweight on right now?
I'll be overweight oil and gas, because I think, Reliance has not performed at all compared to what we've seen if you look back. Similarly, I think banking, people are being very negative about banking, and the slightest positive surprise there would take the indices up, because banking, oil and gas have a substantial amount of weightage. Technology, obviously, stuff like Infosys and all are looking good for the medium to long term, but in the short term, the positives are already in the price. So if you look at stuff like, banking, look at oil and gas, and in fact telecom, everything is negative. Things can't be worse than what they are right now. So slightest uptick there would take the indices up. And just these three, oil and gas, banking, telecom, easily comprise about 50+% of the indices. And any of these sectors giving the positive news in the next month or two can actually lead to a blowout.
Is that structurally the way you're approaching the market now, Sanjay? Just to be a bit cautious about the sectors which have been the leaders, where valuations have expanded, and try and focus on some of the ones which have been relative underperformers in mid caps and large caps, where there is still quite a bit of pessimism?
Yes, I agree with you. Then that's why I mentioned when I started my conversation that you need to get away from the froth that is building up in the mid caps, and you need to actually start to evaluate companies. We still find a large number of companies trading with market caps as low as 150 to 200 crores, 300 crores, or even EVs of just about 400 to 500 crores, but having top lines in it of double the amount and having recent and good margin expansion in the next few years. I think those are the areas one needs to look at and focus on and see what kind of order flows. Of course, issues about quality of management, etc., do arise there, and quality of balance sheets. But if we get a handle on both these issues, quality of management and the balance sheet that is there in front of you, I think money could be made in those stocks selectively.
You keep an eye on media. The last couple of days, the media DTH companies have been moving. I mean, the cable distribution ones, whether it's Dish TV or WWIL. Do you think there is potential there, or too long gestation for your fancy?
No, I think I'm the kind of person who actually entered that sector quite some time back. So I wouldn't say that too long a gestation for my fancy. I've been bullish on that sector. I've held both Dish as well as WWIL for quite some time. I would like to disclose that. I'm optimistic on both these companies, and I think they're set for a good run now in the next 12 odd months, because the sector is actually showing signs of some amount of maturity, some amount of penetration, some amount of EBITDA is turning positive for select companies. So I think a company like Dish, for instance, can easily give a return of about 30 to 40% in the next 6 months with a downside risk of about 10 to 15%, or maybe a little more upside in the next 12 odd months.
While a token repo rate action or some kind of CRR action has probably been accepted by the market, Sanjay, do you think the monetary policy has at all the legs or the ability to break the market's run?
No, I don't think that will happen, because, what's most critical at this point of time is that the companies still need to raise capital. And more than that, the biggest company in the country, that's the government of India, needs to raise capital. So the government is very clear and cognizant of the fact that, it can't let the sentiment break at this point of time. Yes, there is going to be a conflict between RBI and what the government wants. It's going to be a very tightrope walk for the RBI governor. But I think they've done it before and they'll be able to do it again. So I think it'll probably be balanced by some amount of tightening in action by RBI, whereas some amount of aggressive policy measures on the various decisions that are pending by the government to balance the sentiment in the market, because the government needs to sell a lot of paper at this point of time. There is no other option but to make sure the sentiment remains positive.
Just wanted your thoughts on another mid-cap space that's livened up a lot, Sanjay. Some of the auto ancillary stories. Do you track anything there? Anything you like?
Yeah, we like that space, but I think there again, there's a bit of a crowding. It's a bit of a crowded trade. Yes, medium to long term positive, but short term a little cautious there. In fact, on the entire auto sector, while the long term looks good, but I think in the short term they'll consolidate and correct. They may not correct huge because the sector outlook is positive. So similarly, the ancillaries would also be the same. But still, there are a large number of ancillaries which haven't been discovered by the market and are still trading at very low market caps. But unfortunately, what's happened is a lot of these ancillaries, if you recollect 2 to 3 years back, were being played out in terms of a global story, in the sense that, we will become a global outsourcing hub, etc., etc. But unfortunately, the market's so broad, the auto sector and most of the sectors abroad are going through a little bit of a rough patch. So therefore, a lot of them will not be able to maintain the margins or maintain the top line as I thought 2 to 3 years back. So that's the only caveat there. But in terms of domestic demand, I think things are positive.
So between now and the budget, Sanjay, would you put your money on the Nifty holding the 5180 support as it did day before?
May not be 5180, but I think 5100 sure. Then I think it shouldn't go below 5100. I wouldn't mind taking a long trade at 5100, 5140 Nifty if it came down to that level for a 10% ride up and about a 3 to 4% stop loss on the downside.
Thanks.